Hello traders, Gary Wagner here. Just before 10:30 in Honolulu, 4:30 in New York on Monday, the 24th day of March, 2014, and this is the daily report for gold and silver. We have a virtual meltdown in the precious metals markets with sharply lower pricing across the board in the precious metals complex. To gold, as you can see, it's trading on the lows currently, off about $25 on the day at 1308 and change. The low 1308.50, the high 1331, and as I said, currently 1308 puts it off about $25 on the day. Silver also dramatically lower. You can see the board is currently just under $20, $19.95. The low has been $19.84, the high $20.35. We'll talk about silver towards the end of the show. Let's get to gold first. Traders, I want to start the show with this 60-minute chart. Of course, we have gold trading down pretty strongly today, down in double digits, down about $25 on the day. And if you recall from last week, we did issue a very aggressive, what I labeled as a high-risk trade with a very, very tight stop in it. That stop, of course, was hit at 1320, 1319, depending on where you put it. I want to give you an idea of the rationale behind it, how the trade signal was actually generated, and also how it kind of unraveled, because that's all part and parcel of trading. Effectively, what we saw is when the market came down, we had looked at a particular fib retracement level roughly at the 32 level. The one just behind this was at about, I believe, 1312 to 1314. We'll look at that in a second. But what we were looking at that time was this intraday low that was present in the market, and it was just above 1320 at the time. So as this market popped up a little bit, we entered the market roughly at 32 right in here. It made it to about maybe 36, 37, and then started moving south. My belief and my concern was that if this market was to make any kind of a new low, we simply did not want to be in the trade. Now, we never issued a conservative trade alert, and that's because the trade itself never really developed. And let me show you what I was looking at, and really to do that, we really need to look at a daily chart. And traders, I've done just that. I've put up a daily chart in the marketplace, and this is what I was looking at. As this marketplace came up, and we know that this real rally really started at, call it the beginning of this year, we saw this market dramatically move from 1181 up to roughly 1390. You can see that top right in here. We get an engulfing bearish, real strong indication that the market's going to sell off. Following day, we get the confirmation for that. Market does sell off, and then it moves to a specific parameter just at above 1320, and that was right in here. And these were the candles that I was looking at. And what we saw was as follows. We saw the red candle, the doji candle, and the green candle. Of course, traders who have been with me for any period of time know that classically the traditional conservative signal that would have followed because this candle, which is red and a sell signal in terms of the marketplace itself, lower pricing, this would have had to have been green with a higher high and a higher low. That would have given us confirmation. Of course, that is not how the market unfolded. And in fact, we saw weakness. And when we look at this market now and look at any kind of candlestick pattern, you actually have gotten an engulfing bearish, similar to this, in that you have this red candle trading through the entire previous day's range. Red candle trading through the entire previous day's range. In other words, the body is engulfing the prior body. What I was looking at was the potential for a 3-river morning star variation. And that is why it's an aggressive signal, because on an aggressive signal, I'm not really waiting for confirmation. We're trying to get a better price. We're trying to get a jump. We're also doing it in such a way that if we're incorrect, we really, really limit the risk to a small of a risk exposure as possible. In this case, it was about $12. And for those of you that have followed me, you know that typically I'm trying to catch large parts of a range within a particular trend, no trend actually developed, and what we're getting is a continuation of this market to the downside. So absolutely the $64,000 question becomes, where will this downside stop? Have we caused any long-term damage? Those are the two questions we're going to answer all on today's daily report. So the first of those two questions that I want to tackle is, have we really created any kind of long-term damage on these charts? We're going to look at two different charts to kind of come to a conclusion or our observations of that question. When we look at this is a very, very long-term, it's a 9-day chart, a little bit less than 2 weeks, a little bit more than a week. And when we take a look at the top of this market, we can easily identify, one, this doji in the middle. We can easily identify a shooting star and the fact that it is a three-river evening star formation. Realize that typically at these tops, you're going to get this kind of formation because what's really happening is you're looking for that, we call it a V. On the top is an inverted V and a V on the bottom. And so we're looking for really that pivot point. That's what this inverted V or V are all about. And as you get to the top, you get this long green candle. That's telling you that the bulls are in definite control. They're moving the markets to higher ground. But you then get the center candle. This is that consolidating candle or that doji. And it tells you that neither the bulls nor the bears have absolute control. And it's kind of like a handoff in that really what's happening here is the following candle shows where the bulls no longer control the market, and really the bearish faction is absolutely controlling it, and that's by virtue of the red candle. So you can see that these kinds of pivot points do occur not only at the tops of the market as we're seeing here, but they also occur at the bottoms, as you can see right in here and right here with this almost this elongated kind of rounded bottom. But if you look at the quantity of small candles that come in, it really tells you the market's consolidating, and that's where we hit that bottom. Long-term damage in the market, my direct answer is no, because we really expected some sort of correction to come in at some point. And really what I'm looking at is we have not been able to now answer whether or not we can categorically state with 100% certainty that we've gone into a bullish phase as opposed to a counter trend, and that is really because of the way it came back in the channel. We'll look at our other daily chart that has our Andrews pitchfork, and I'll kind of elaborate on that point. But really what I'm looking at is market comes down. I believe that this really was something like an A, a B, and a C. That's the numbering that I'm looking at in terms of the market. I do believe we probably concluded this M4, and that's what's important, because in fact, if we are in a major fifth, we have not in any way incurred any kind of long-term damage in the market. In fact, what we're looking for is some sort of a 1, a 2, a 3, a 4, and a 5. So some sort of a 5 count up in that major fifth. Now, of course, in that major fifth, you're going to have 5 waves, and of that 5 waves, you are going to get 2 corrective waves, waves 2 and waves 4. So does it cause long-term damage? You have to say it hasn't, because there's still that opportunity for the market to really move up the channel. What is disconcerting, though, and what is kind of putting us on hold right now is when we take a look at how it reacted vis-a-vis the Andrews pitchfork. Let's go ahead and pull that up. And this is the chart I was referring to. Let's see if I can't blow this up just a little bit. You know, I got all excited, obviously prematurely, but I got all excited when we saw, for the first time since we put in the Andrews pitchfork, actually taking out and moving above this zero line prong. But just as in Bollinger Bands, it kind of snapped back into play, broke back through, and is now tracking lower. The question is will the market have to fall down to this 23% level before moving back up? Because without the market trading really through this particular point, that's the final piece of evidence that really tells us that we've broken out of any kind of a bear market. In terms of this bull rally, it is more of a bullish rally than a counter trend to the bear market that will resume. If we cannot exceed and break through this particular point, it tells us that we are not looking at a counter trend. And in fact, we are simply looking at a bear market at the top of its range, now moving towards the lower aspects of the range, meaning back into this particular Andrews pitchfork. My sense is, and realize I'm a bull eternal, but my sense is that at some point, either at this 23% level or above, we will see this market recoup. We will simply look at this as a double bottom, and then B, wave 1, wave 2, and then wave 3, something like that. We'll have to see how it unfolds, but right now, my sense is that we have taken away the ability to say this is a full-blown bullish rally. We could be in a counter trend. We could be in a bullish rally. We won't know unless we challenge and take out this upper prong. And right now we're under pressure. However, in the big picture, even if the markets were to really unfold in the way that we just had talked about, let me change the candle color, meaning we're getting a wave 1, a wave 2, and then a wave 3. Even if it was to unfold in this way, we would still need to get this corrective wave, this wave 2 right in here. The other thing, and I talk about this, hopefully you've had a chance to view the after the show, because what I do talk about, the good news that comes out of all of this, and this is what our primary topic is going to be this week, is that with this one wave in place, this A wave, we can now begin to create certain models, and these models are going to tell us if it retraces to X point, and then if wave 1 equals wave 3, and actually put together some price structures, because we use wave 1 as our primary benchmark. Wave 1 is the one wave that we cannot ascertain any kind of distance move in there, where it's going to go, how far it's going to go, how many dollars it's going to ascend. What we can do is we can use that as a benchmark once we see the conclusion of that first wave and then begin to create our models. So what does that mean in terms of where we believe this market could go to? And to do that, we'll need to pull up another chart. So traders, I've done just that. I've pulled up a daily chart. On this daily chart, standard candlestick format, we have two basic fib retracements. One, the entire span of the rally, 1181 up to 1390. The secondary one is looking at the fact that we saw the market kind of rise and then come back down. So we're starting from here. And so the secondary fib retracement, which you can see are on the hash marks on this side, the longer one on this side, is really starting from what, about 1237 up to the same top. When we do that, the area that has interested me the most is the area that we've actually just broken through. We're trading 1309. My question is, will we be able to recoup? Because a move and a close above this says one thing. A close and a continuation of this sell-off closing below this line gives me another piece of indication, and this is what I'm looking at. If the market continues under pressure, the next real level that we have to look at is between 1289 and 1295. So it's going to be this particular band, and that's based on a 50% retracement of our large fib and a 61% retracement of the shorter move. So it would be this band. So what we would be looking for is, on a continuation of pressure, we would look for the market to track lower, find support somewhere in this area, and then begin to trade off of that area. That's one model. The other model would look for it to move back into alignment in terms of this 1314, 1313. And the reason that I'm even holding out any kind of hope, and it's not really hope eternal so much, is the fact that this is an important fib number, I believe, because of the harmonics. You're getting 38% and 50% really showing you the same area. We're just below that area. I have seen many times where it will track just below and then find a little bit of support to move up. So in other words, this particular level holds even with it trading just underneath. However, as the market stands right now, unless we see some effective closes today or tomorrow above this point, as I said, I would look for the market to genuinely track to the $1,300 level, possibly then find support. If that is the case, this is an excellent opportunity for us. We are going to obviously sideline on gold. We've had a couple of really solid trades. We started off the year rocky. We gave up $12 of that. Do I feel good about it? No, I don't. It was an aggressive call. We never issued the conservative call, so nothing ever really actualized on the trade. And from what I've gotten in terms of emails, only my most aggressive traders actually went in and took that. I labeled it in such a way to give it enough warnings that many of my conservative traders said they'll wait for the conservative call. And that's something that you can't do anything but recommend, especially when you have volatile markets like this. So what about silver? Well, actually our stop hasn't been hit in silver, although if you took that aggressive call, you might want to exit the market. I believe the stop's just below 75, but the key on silver really has, when we saw gold break, we didn't see silver follow through. When we look at this long-standing resistance line, it is absolutely still intact. And this particular resistance line really guided the tops of the markets. Where support, we've got support at 75. We then have support at 1958. We'll have to see how this market plays out and unfolds over the next couple of days. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.